You did the right thing. You built an emergency fund, you saved the money, you put it somewhere safe, and you left it there. That took discipline, and most people never do it. Here is what nobody told you. The account you put it in has been quietly costing you money every single month since you opened it. Not because you did anything wrong, because you used the default. And in personal finance, the default is almost always the most expensive option available. If your emergency fund is sitting in a standard checking account or a traditional savings account at a major bank, it is earning approximately 0.01% interest per year. On a $10,000 emergency fund, that is $1 per year. $1. While inflation runs at 3 to 4% annually, meaning your $10,000 is losing approximately $300 to $400 in purchasing power every year it sits there. My name is Harvey, and today I am going to show you exactly what your emergency fund should be earning, where it should be sitting, and how to move it in about 15 minutes without touching the emergency fund itself. Let me start with a number that should make you uncomfortable. The average high-yield savings account currently offers between 4 and 5% APY. The average traditional savings account at a major bank offers 0.01% APY. That is not a small difference. That is a 400 to 500 times difference in what your money earns while it sits waiting to be used. On a $10,000 emergency fund, the standard recommendation for most single-income households, here is what that difference looks like over time. At 0.01% APY, your current traditional account, after 1 year, $10,001. After 5 years, $10,005. After 10 years, $10,010. At 4.5% APY, a competitive high-yield savings account, after 1 year, $10,450. After 5 years, $12,462. After 10 years, $15,530. Same $10,000, same emergency fund, same zero additional contributions. The only variable is the account. Over 10 years, the difference is $5,520. That is not a rounding error. That is more than half the original emergency fund balance, generated by doing nothing except choosing the right account. Here is the framework that explains why this matters. An emergency fund has 3 requirements. Every dollar in your emergency fund must meet all 3 simultaneously. Requirement 1, liquidity. You must be able to access this money within a reasonable time frame when an emergency arrives. Days, not weeks. This rules out CDs, bonds, and investment accounts where market timing or penalties could affect access. Requirement 2, safety. This money must not be at risk of loss. This rules out stocks, cryptocurrency, and any investment vehicle subject to market fluctuation. Your emergency fund cannot go down in value because the emergency does not care about market conditions. Requirement 3, yield. Subject to the first 2 requirements being fully met, this money should be earning as much interest as possible. Not because you are greedy, because inflation is real. Every year your emergency fund earns less than the inflation rate, it is shrinking in real terms, even though the number on the screen stays the same. A high-yield savings account meets all 3 requirements simultaneously. It is liquid, funds are accessible within 1 to 3 business days. It is safe, FDIC insured up to $250,000, identical protection to any traditional bank account. And it yields, currently earning 400 to 500 times more than the default option. Your traditional savings account meets requirements 1 and 2. It fails requirement 3, and that failure compounds quietly against you every single year. So why does almost everyone end up in the wrong account? Default bias. When your paycheck arrives, it goes to your checking account. When you decide to build an emergency fund, the easiest move is to open a savings tab in the same bank app, transfer the money, and call it done. The decision feels complete. The money is moved. The task is finished. But the default savings account at your primary bank, the one that opened automatically when you signed up for checking, is designed for convenience, not yield. The bank profits from keeping your money at 0.01% and lending it at 7 to 8%. The spread between what they pay you and what they charge borrowers is how traditional banking works. Your default savings account is not neutral. It is a profit mechanism for the bank, funded by the difference between what you earn and what they earn. A high-yield savings account, typically offered by online banks and credit unions with lower overhead than traditional institutions, passes more of that lending spread back to depositors. The yield is higher not because of some financial magic, but because the business model is different.
Let me address the question almost everyone has at this point. Is it safe? Yes. High-yield savings accounts at FDIC member institutions carry identical federal insurance to any traditional bank account, up to $250,000 per depositor per institution. The FDIC does not distinguish between a traditional savings account at Chase and a high-yield savings account at an online institution. The protection is identical. The only meaningful difference between your current account and a high-yield savings account is the interest rate, and that difference currently runs to hundreds of dollars per year on a standard emergency fund balance. Now, let me show you the proximity trap and what it actually costs. Most people keep their emergency fund at the same bank as their checking account. The reason feels practical. Easy transfers, one login, one app. The cost feels invisible. Approximately $449 per year on a $10,000 balance at the current rate differential. Over 5 years at current rates, keeping your emergency fund at the wrong bank costs approximately $2,457 in foregone interest. Over 10 years, approximately $5,520. This is money that existed. It was available to you. It required no additional contribution, no additional risk, no additional discipline. It required one afternoon and one account switch. The proximity trap does have one advantage worth acknowledging. The friction of accessing a different bank can slow down impulse withdrawals from the emergency fund. But that friction is available regardless of which high-yield account you choose. And at 4.5% APY, you are being compensated for it, rather than penalized. Here is what the move actually looks like. Step 1. Choose a high-yield savings account from an FDIC-insured online institution. Look for current APY above 4%, no monthly fees, no minimum balance requirements beyond a nominal amount, and FDIC insurance confirmation on the institution's website. Step 2. Open the account online. This takes approximately 15 minutes. You will need your social security number, a government-issued ID, and your current bank account information for the initial transfer. No branch visit required, no complex forms, a 15-minute process. Step 3. Transfer your emergency fund balance from your current account to the new high-yield account. Set up a small automatic monthly contribution if your fund is not yet at its target. This is optional but efficient. Step 4. Leave it alone. The emergency fund is not an investment account. You are not watching it grow for motivation. You are placing it in the highest yield liquid safe account available and returning to your life. That is the entire process. 15 minutes of setup, hundreds of dollars per year in return. Let me show you what this looks like across two people. Person A has a $10,000 emergency fund in a traditional savings account. They built it 3 years ago, they are proud of it, and they have not thought about it since. Over the next 10 years, it earns $10 in interest. Inflation erodes approximately $3,400 of its purchasing power. Their $10,000 emergency fund, in real terms, is worth approximately $6,600 by the time they need it. Person B has the same $10,000 emergency fund. They spend one afternoon switching it to a high-yield savings account. Over the next 10 years, it earns $5,530 in interest. The interest largely offsets inflation. Their $10,000 emergency fund, in real terms, retains most of its value and has grown to $15,530 in nominal terms. Same starting point, same discipline, same emergency fund. The only difference is 15 minutes and one account decision. Here is what I want you to take from this. You built the fund. You did the hard part. You saved the money during months when saving was difficult. You left it alone when spending it would have been easy. And you have maintained a financial cushion that most Americans do not have. The account switch is not the hard part. The account switch is 15 minutes. Your emergency fund is a financial instrument. It has a job to do, to be there when you need it, safe and accessible. But it has a second job while it waits, to hold its value against inflation and earn whatever yield a safe, liquid account can earn. Right now, for most people, that second job is not being done. Move the fund. keep the discipline. Make the money work at both jobs simultaneously.